Hi, everybody. We're Group 4. My name is Nick,
I'm Peter.
I'm Jin-Song.
and today we are going to be talking about Ireland. All right, so here's a brief overview of the content we are going to cover today. Among other things, we're going to discuss the just overall country overview and its economic condition, its balance of payments, and some exchange rate movement of its home currency. All right, so I'm going to start off by talking about Ireland's GDP and economic growth. So as you can see on this graph here, the GDP growth of Ireland has been on the decline in recent years, and it actually went negative to negative 0.9 in 2023. However, there is a projected increase in economic growth in the coming years, going to 3% in 2024 and 3.4 in 2025. This growth is coming as a result of a strong labor market and rising real wages, which is leading to an increase in consumption spending. All right, and now I just want to talk about some of the main trading partners of Ireland. So as you can see from these charts here, the predominant import and export destinations for Ireland are the United States and the United Kingdom, which is not really surprising to anyone. And their top exports are pharmaceutical products and organic chemicals. And I'm just going to go over some basic economy facts about Ireland. So, Ireland is currently facing a budget surplus of 11 billion euros, and it is one of the only Eurozone countries to be experiencing this. This is a result of record high corporate tax income, and they have such a high corporate tax income because they're known as a tax haven by many businesses. They have an incredibly low corporate tax rate compared to the rest of the world, and this helps to draw in a lot of FDI and foreign businesses to set up subsidiaries within Ireland, which is helping to boost their corporate tax income. However, their status as a tax haven is in jeopardy based on a global tax reform, which I'll discuss a little more later.
So for our exchange option, our mission is to obtain 280 million euros. And what we chose is to buy core options, which can protect against the appreciation of the euros. On October 11th, the strike price was $1.06 per euro, and buying 1 euro with a premium of $0.00958. And our current exchange rate on December 1st is $1.09 per euro.
Cool. So to give a current state of the balance of payments, I wanted to go through the numbers of different accounts. To start with the current account, we see a quarter three surplus of 20.7 billion euro, which represented 16% of their GDP during that quarter. This was an increase of 11.2 billion from fiscal year 2022 quarter three numbers. Um, so far in fiscal year 2023, there was a surplus of 50.1 billion, which was an increase from last year's 39.4 billion. To add some context to these numbers, the increases in service and income balances have been offset by a slight decrease in merchandise. The merchandise balance, which has ultimately led to the overall increase, as you can see within the image, you can see that merchandise balance has decreased over the first three quarters of 2022 versus 2023, and service and income has increased over that time period as well. Going through financial account, direct investment in foreign assets increased 23 billion versus direct investment made abroad increased by 7 billion. The increase in these direct investments ultimately came down to the increase in reinvestment earnings and other capital investment, which were also partially offset by the decrease in overall equity investment within the country. Portfolio investment in foreign assets in both debt instruments and equity increased 50.7 billion and 31.1 billion respectively, and then portfolio investment made into Ireland increased 43 billion. So the portfolio investment increases came within through the form of debt and equity, as discussed in the numbers, and the increase in portfolio investment made into Ireland mainly came due to equity investment. Talking about the reserve assets, over the last couple of years, you can see that the reserve assets was in a surplus in 2021 of almost 5 billion and has decreased since then. In 2022, being just over 500 million in surplus, and now trending toward being a negative $500 million deficit. This indicates that Ireland has been either been using its reserves more than usual, or they've been borrowing from other countries as they have fight inflation, which has been peaked at near 10%.
So here is our exchange rate movement. $1.06 per euro was our initial exchange rate, and our current exchange rate is $1.09 per euro. And euro had a worse experience on September of 2022 due to some factors, including Ukraine invasion and burden of monetary policy gap between Federal Reserve and the European Central Bank. Except special change in economy like I mentioned above, euro had less volatility compared to other currencies, including other major currencies like US dollar or Japanese yen. Including three fundamental approaches, we concluded that euro would stay or appreciate in the short term and long term.
So, talking about the Irish Stock Exchange, or what they call the Euronext Dublin. The Euronext is a combination of a whole bunch of different cities within the EU and their stock exchanges, and then they're split into separate ones such as Euronext Dublin or Lisbon, Brussels, Amsterdam, Milan, Oslo, and Paris. Um, in the Dublin specific one, there are 38 stocks traded with a rough market cap of 148 billion euros. And over the last 5 years, 21 companies have left versus 5 have joined, which is not a great sign for the overall strength of this exchange. Um, a report done by the Federal Reserve back in 2015 showed that companies have that have had cross listings in better markets, such as the New York Stock Exchange, have had better valuations over the next 5 years, um, which has shown to make companies want to leave Irish Stock Exchange as well as the London Stock Exchange to better opportunities abroad. Um, Two main factors or companies within the stock exchange that have left are Flutter and CHR. Flutter is a gambling site or company that has affiliations with FanDuel, and then CHR is a materials company. These two companies have left or are expected to leave, and both represented over 40% of the Irish equities value within the exchange. Flutter, I believe, is expected to IPO in the New York Stock Exchange in the first quarter of 2024, and CHR is currently listed on the New York Stock Exchange. I also wanted to briefly go over the London Stock Exchange, as it is also struggling and leading companies to leave both indexes, as Flutter and CHR have had dual listings, as well as many other companies have had dual listings on both exchanges. The FTSE, which is their version of the SPY, is up 16% since 1999 versus what the S&P is up 215%. So that discrepancy there, and just the overall less liquidity involved within the Irish Stock Exchange, is leading to a bleak outlook, in our opinion, on the Euronext Dublin.
All right, now I just want to talk about some risks that countries doing business, or not countries, businesses doing business in Ireland will face. So the first thing is that Ireland has a very small and open economy, so they're just much more vulnerable to political risk and outside global factors. They can be much more impacted than, say, a much larger country or a much more closed off country. So businesses need to be aware of that. Another thing to be aware of is there are less liquid capital markets in Ireland. As Peter just mentioned, there's not a lot of capital available in certain equity markets. The third thing to be aware of is the repercussions of Brexit. So Britain left the EU and that has finalized. However, there's still a lot of tension between the two entities. And as Ireland is part of the EU and they do a lot of trading with the United Kingdom and Great Britain, them being one of their largest export and import partners. Any tensions between the two could have an impact on businesses and the country of Ireland as a whole. The final thing to be aware of is the global tax reform that is currently happening. This is something that's supported by 138 countries, and it calls for a 15% minimum corporate tax rate, which will most likely go into effect in 2024. This can have some big impacts on Ireland because they draw in a lot of foreign direct investment through their crazy low tax rate, and this will most likely change in the coming years. So businesses need to be aware that the tax rates are going to change and the business environment as a whole will change.
So for FDI, foreign direct investment options, we concluded that US firms should not apply FDI due to 4 reasons. Global tax rate will change to 15% in 2024, which changed investors' interest of Ireland's tax rate meaningless. And compared to other major European countries, Ireland has less market liquidity. And also, Brexit changed investors' interest in European countries because Brexit seems that European countries are not working together, which makes economy less flavorable. And lastly, strategic hub. There are other options where US firms can use as strategic hub.
All right, and now I want to talk about foreign currency need. So as we mentioned earlier, in October, we purchased call options to hedge our need for 280 million euros needed on December 1st. They had a strike price of $1.06 per euro and a premium of 0.00958. Now, the exchange rate on December 1st was $1.09 per euro, which means we were in the money and the hedge was successful. We were able to pay less for the euros that we needed than we would have had to if we had just waited it out and bought them at the current rate on December 1st. Now, an interesting thing to think about is, would futures have worked better? Now, if we had bought a future, we would have been able to get the euros for $1.06 without having to pay the premium. However, this doesn't take into account the fact that we didn't know where the current exchange rate was going to be. And so that would have eliminated any possibility to take advantage of any depreciation of the euro because we would have been locked into the $1.06 strike price. And so we would have had to just buy the euros at that price as opposed to being able to avoid exercising the options and take advantage of that trend if we had taken the options. So, in my opinion, with the benefit of hindsight, futures might have worked better. However, at the time, I believe we made the best decision we could have, and the hedge was successful. So, overall, I think we made the smart decision.
Cool. Thank you guys for listening to our presentation about Ireland and foreign direct investment within Ireland. If you guys have any questions, just comment them on this post and we'll get back to you within the day. Thank you.